Tax strategy versus bankability. The trade-offs. Getting too aggressive. We talk about striking balances, being smart, using the deduction items that are added back. Interest, depreciation, officer compensation, namely, understanding what the write-offs are, understanding how they can be added back. That's so important. And being overly aggressive. There are times where maybe a business could be showing profitably, but you elect to show less strength. By definition, when you show less strength, you show less repayment ability. That reduces the likelihood of a bank, institutional lender extending credit to you. Because again, all about repayment. Very, very important about repayment, your historical repayments to others, personal commercial credit. But what's the balance? How do you strike that balance? Your accountant wants to reduce the tax liability. You might need access to capital to expand your business, acquire another business, acquire a building, whatever it is, equipment finance, among other uses of proceeds. You need marketing, you need to hire, and for salaries and wages, whatever the use of proceeds is. If you're overly aggressive from a tax strategy perspective, which consult your tax professional, this is not to consult you from a tax perspective. This is for you to understand bank eligibility. And from a bank eligibility perspective, the less strength you show, the less likely you are to get approved. Because banks lend money to businesses that on paper appear not to need it, which means they have excess liquidity, they have earnings, they have net income, they're strong, they have good balances, they have good credit. That's what they extend credit to. So very important to understand, and you can have the conversation with your accountant, and you have to show strength. At some point, you have to have a year where that means that you're paying taxes. And that's your good job. You did great, now you owe some money for taxes, but that's the difference between getting that $350,000 10-year SBA term loan and not. That's the difference right there. Showing your true strength, as opposed to aggressively, from a tax strategy perspective, reducing your tax liability by showing weakness to the IRS, because again, by definition, when you show strength and a lot of strength, there's tax associated. Speak with your tax professional, consult them, and make sure you're using the right deductions that are added back in a banking capacity, so you don't reduce your approval odds, and you're still showing strength while still maintaining a reduced tax liability. There's a balance you can strike. Consult your tax professional. We'll keep moving forward.